Okay, so you know how you guys sent over James Montier's The Little Book of Behavioral Investing? Well, we've been digging into it, and let me tell you, it's been pretty eye-opening.
Yeah, it's really fascinating stuff.
Right, like it's almost like a cheat sheet to figuring out all those mental traps we fall into when it comes to money and investing.
I think that's a great way to put it, a cheat sheet. Because it's not just about the numbers, is it? It's about understanding ourselves.
No, not at all. And that's what Monty really gets at, like why we make those decisions that looking back, you're just like, what was I thinking?
Exactly. So today we're going to try to really break down those key insights from Montier, all about those psychological biases he talks about, those common mistakes we make, the role our emotions play, and how we can become more disciplined and long-term focused for better outcomes.
And I think everyone listening has probably felt this at some point, that, feeling of absolute certainty about an investment, right? You're like, this is it, this is going to be huge. But Montier kind of flips that script, doesn't he? He says that strong feeling of conviction could actually be a red flag.
He does, and it all starts with understanding how our brains work. He talks about these two systems of thinking.
Right, the X system and the C system. And I love how he illustrates this with, that classic bat and ball riddle.
Oh, yeah, the one that always trips people up.
The bat and ball cost $1.10 total. The bat cost $1 more than the ball. So how much does the ball cost?
I bet most people listening right now are thinking 10 cents.
Right. That's our gut instinct, right? 10 cents, it just seems like the obvious answer.
That's the X system kicking in, that fast, automatic, intuitive thinking.
But if we actually slow down, engage that C system, the more deliberate, logical part of our brain.
You do the math and realize, wait a minute, the ball actually costs 5 cents.
5 cents, exactly. And that's such a simple example, but it shows how our quick reactions, especially with money, can lead us down the wrong path.
And Monty makes this really interesting point. He says that this kind of fast, often optimistic thinking, that X system, it was actually crucial for our ancestors' survival.
Oh, how so?
Well, think about it. They needed that quick, optimistic response to threats, to jump into action.
Yeah, to make split-second decisions.
But in today's world, especially with investing, which is all about long-term thinking, that same optimism can actually work against us.
Because it can lead to overconfidence.
Right. That's one of the big ones, overconfidence. We have this natural human tendency towards optimism. It's part of our wiring.
And it makes sense, right? You need some level of optimism to, get out of bed in the morning.
Of course.
But when it comes to investing, it can morph into this inflated belief in our own abilities. Like we have more control over outcomes than we really do.
That's the illusion of control Monty talks about. And, he uses the example of lottery tickets. Have you ever heard this one?
No, tell me about it.
Well, studies have shown that people are actually willing to pay more for a lottery ticket if they get to choose their own numbers.
Really? Even though the odds are exactly the same?
Exactly the same. It doesn't make any logical sense.
Wow. But it shows that deep down, we crave that feeling of control, even if it's an illusion.
And when you think about it, that's a powerful force in investing too, right? We want to believe we can pick the winners, time the market just right.
So where does, actual skill and expertise come in? Like, how does that play into overconfidence?
Well, Monty talks about this too. He compares different professions. Like, think about weathermen. They're constantly dealing with probabilities.
They're saying like a 40% chance of rain?
Right. And they're okay with being wrong sometimes. It's just the nature of their work.
Then you have doctors. We tend to place a lot of trust in doctors.
And they often have higher confidence, maybe because of that trust we put in them.
So where do fund managers fit into all of this?
Well, here's the kicker. Monty suggests that fund managers are often even more overconfident than doctors.
Oh, wow, really?
And that's because they believe in their expertise, in their ability to predict the market.
And it's appealing, right? As investors, we're drawn to that confidence.
It makes us feel like we're in good hands, like we've found someone who can see the future.
But the data, what does the data actually say about all those predictions?
Well, the data is pretty clear. It shows that on average, actively trying to forecast the market, it doesn't really give you an edge over just investing in the broad market itself.
So maybe it's more about, the presentation, the confidence with which they deliver those predictions.
Could be. And this overconfidence can lead to some pretty big mistakes. Montier talks about IPOs as an example, initial public offerings.
Oh, yeah, those are all about hype, right?
So much hype. You get caught up in the story of this new company, the promise of huge growth, and you end up paying a premium for that potential.
But isn't that what investing is all about? Betting on the future.
It is. But Montier points to research showing that, on average, U.S. IPOs have actually underperformed the broader market in their first 3 years.
So that fear of missing out, the hype, it can really cloud our judgment.
It definitely can. Another big one Montier digs into is confirmation bias, and this is something we all do.
Oh yeah, confirmation bias, it's like we're searching for evidence to support what we already believe.
Exactly. Once we've formed an opinion, it's hard to let go. So we tend to filter information, we see what we want to see.
And ignore anything that doesn't fit our narrative.
Right. And this is really dangerous in investing because it stops us from seeing those potential downsides, the flaws in our thinking.
So how do we combat that?
Montier stresses the importance of actively seeking out information that challenges our views. Instead of just looking for reasons why to buy, we should be asking why not to buy, or what could go wrong.
He even talks about Bruce Berkowitz, the investor, and his approach of trying to kill the company, right?
That's right. When he's evaluating a company, he looks for all the ways it could fail. It's a way of stress testing your ideas.
Now, let's talk about something that I think everyone can relate to: loss aversion. That feeling that losing money just hurts so much more than gaining the same amount.
It's true, isn't it?
Yeah.
And Monty explains that this isn't just some emotional quirk, it's wired into our brains. We're just more sensitive to losses than to gains.
It's like our brains are programmed to avoid pain.
And this aversion to loss is linked to another bias, the endowment effect.
Oh, that's the one where we tend to overvalue things we own just because they're ours, right?
Exactly. It's like that classic example with the wine collector. They have a bottle that's gone up in value, but they're hesitant to sell it even at the higher price.
Like they're emotionally attached to it.
Exactly. But they wouldn't necessarily buy the same bottle at that price if they didn't already own it. It's irrational.
It's fascinating how our emotions can influence our perceptions of value.
Absolutely. And, loss aversion can make us overly cautious, even when taking some risk would be beneficial in the long run.
And it can cause us to hold on to those losing investments for too long, hoping they'll bounce back.
Just to avoid realizing that loss, yeah. And it can lead to us checking our portfolios way too often. The more we look, the more likely we are to see those short-term fluctuations, the losses, and that triggers that pain response.
It's like we're constantly picking at a scab.
And then there's the trap of sunk costs, which can also really mess with our decision-making.
Oh yeah, sunk costs, that feeling that we've already invested so much, we have to keep going even if it's not working out.
That's the fallacy, right? We feel like we can't waste what we've already put in, whether it's time, money, or effort. But sometimes the best decision is to cut your losses and move on.
And Montier also talks about these empathy gaps, which I thought was such an interesting concept.
Yeah, empathy gap, it's basically our inability to accurately predict how we'll feel or act in a different emotional state.
He uses the example of overeating, right? Like you're stuffed, you swear you'll never do it again, but then you get hungry and all those good intentions go out the window.
It happens to the best of us.
Yeah.
And how do you think this applies to investing?
Well, I guess it's about understanding that how we feel when the market is calm and doing well is not necessarily how we're going to feel when things get rocky.
Exactly. When the market is up, we might have this clear plan. We're going to buy more. If there's a dip, we're going to stay the course.
But then that dip happens and fear takes over. We panic. We might even sell.
Monty calls this terminal paralysis. And he points to the 2009 market crash as a prime example. So many people just froze. They couldn't stick to their plans.
So how do we bridge that gap, that empathy gap between our calm selves and our panicked selves?
Monty's solution is pre-commitment. This means making your investment plan when you're rational, when your C system is in control, and then commit to sticking to it no matter what.
It's about setting the rules in advance so your emotions don't hijack your decisions.
Exactly. And then there's another interesting bias he discusses, action bias.
That's the urge to do something, anything, even if doing nothing is the better strategy.
It's that feeling that we need to be constantly tinkering, trading, being active investors.
And I love the analogy he uses here, the soccer penalty shootouts.
Well, yeah, where goalkeepers would statistically save more goals if they just stayed in the center.
But they feel this pressure to dive, to do something, even if it lowers their chances.
It's that same impulse in investing. We think that constant activity equals control equals success.
But as Montier points out, especially for long-term growth, patience and discipline are key.
And he even mentions how the average holding period of stocks has decreased significantly over time, which might be a sign of that increasing action bias.
Like we're just so quick to jump in and out of things.
And Montier reminds us of Ben Graham's advice. The value approach is inherently sound. Devote yourself to that principle. Stick to it and do not be led astray.
Which brings us to the idea of contrarian thinking, going against the crowd, buying when everyone else is selling, and vice versa. Sounds simple, but emotionally, it's tough.
It is, and Montier warns us it's easy to think you're being a contrarian while still being influenced by the herd.
We need to be really honest with ourselves about that.
And there's a neurological reason why it's so hard. Montier talks about how our brains, specifically the amygdala, which is involved in fear and emotion,
It lights up when we consider going against the group.
it feels dangerous, even if logically it might be the right move.
So true contrarian investing takes guts, it takes discipline.
And Montier stresses the importance of focusing on your investment process, your research, your methods, rather than getting swept up in the short-term noise.
So bringing it all together, how do we actually manage all these biases, these mental traps? It can feel like we're fighting our own nature.
Well, Montier's main point is that we have to consciously engage that C-system thinking, the slow, logical part of our brain.
We need to cultivate critical thinking, challenge our assumptions, and look for information that contradicts our beliefs.
He even mentions certain types of funds, like balance advantage funds, that try to mitigate some of these biases through their strategies.
By automating some of those decisions.
Right. And ultimately, as Montier says, the biggest obstacle to investment success is often not the market, but ourselves, our own biases.
So for you, the listener, the takeaway is this. Understanding these psychological tendencies, the overconfidence, the loss aversion, the herd mentality, it's the first step to making better decisions.
Absolutely.
And with all of this in mind, what's one thing you can do this week to re-examine your own investment process?
I like that.
Thanks for joining us for this deep dive into Montier's The Little Book of Behavioral Investing.
It's been a pleasure.
We hope it's given you some food for thought and some tools to navigate those mental minefields. We'll see you next time.
Until then.